All right, guys, welcome back to another episode of The Deep End, our first one of 2026, actually. So happy New Year to everyone. We are joined today by the great and powerful Paul Santori. Paul, thank you so much for joining us, man. As per usual, I know we've said this before to you guys tuning in, and it always happens this way. Before we hit record, we'll start talking about something, and then inevitably one of us, either Ari or myself, will be like, hey, should we actually should this be part of the conversation? This is good stuff. And if we don't start it, then we'll talk for like 30 or 40 minutes before actually recording. So we were having a good chat before we started recording. We kind of tabled it for a second so we could hit record. Let's pick it up where we left off. Ari, set the stage for us, man. Where were we at?
Yeah, for sure. So Ryan, I'm happy you stopped me because I think all of YouTube needs to hear what's been going on, at least on my end. And I'm happy Paul is on with us today. Paul, it's really an honor to have you as the first guest in the new year. But Paul and I actually recorded a video for everybody to end 2025 and to kick us off into 2026. We were talking all about income investing, and I'm sure we're going to get a lot into income investing in this video, just based off of Paul's strategy, the success that he's seen. And so I wanted to, Paul was on Masters of the Market before, and I wanted to bring him back on to really talk about like transitioning a portfolio. Now, I was super excited to get that video out at the end of 2025. And within like 18 minutes of that video going up, I was shackled and put into YouTube jail and saying that video, Paul and I were encouraging illegal activity and, everything in between, which is just craziness. So anyways, I had to wait to post anything. I haven't been able to post anything yet, which has, been a total bummer. Now, I will say, Paul and I didn't talk about anything illegal, nor were we encouraging illegal activity. We were just talking about Paul's journey as an investor. So I hope that's not illegal. But, where I'm at right now, I think I'm officially out of YouTube jail. I have to see if I can post a video tomorrow because I'm still going to try to repost that video with Paul, different title, different thumbnail. But I think, Paul, you had a lot to say. And so I just want to circle back to like welcoming you now to the deep end and welcoming all of us now here to 2026, which is crazy. But let me just pass this ball over to Paul. Paul, how's your new year been? And how are you feeling since our chat?
You know what? I'm feeling great today because this is so exciting. To be invited on the deep end, I think is an honor. And I love both you guys. Your channels are amazing. Fantastic motivational content that I know is inspiring a lot of people. Ryan, I watched your video. I think it was your end of year summary of what you did, and I saw there was at least 16,000 views. So I know there's a lot of people who are really interested in your content. And anyways, guys, I'm excited for 2026. Before I got on with you guys, I've been sitting downstairs working on my computer, getting my end of year videos ready, working on other content. And I'm starting to wonder, like, does everybody sit in front of the TV and work on YouTube 10 hours a day, or is it just me? Because it's becoming a full-time job.
Yeah, no, it certainly can be a full-time job. And I think, well, and it can be long days, sitting in front of the computer. It can drive you a bit stir crazy, as I'm sure you've experienced. But in those moments, I always tell myself there's a lot of worse things I could be doing.
True.
And it's such a rewarding, as you've experienced, it's such a rewarding thing to do for some of the reasons you mentioned a moment ago. There's just a lot of people who, get motivation and inspiration out of watching this stuff. I don't know why they get it from people like us, but they do, and I'm not going to question it. And so it feels really good to hopefully be a positive force for people who are trying to do a positive thing for themselves in their future, because that's what it's really all about at the end of the day. So it's like those long days staring at the screen are totally worth it.
I always start with going through comments, right? Just to read what people have written on previous videos. First of all, I want to acknowledge them to say thanks. Thank you for watching the video and making a comment. But then you get those comments where people acknowledge what you're doing and how you're helping them. And then it's like, okay, now I got to make 5 more videos. This is awesome. So it helps with the motivation a lot for sure.
You know what I think is amazing? Ryan touched upon it, and then I think even Paul, the point you were making, I can touch upon it with that one as well. But like all three of us are such average guys, who just started to showcase our journeys. And I think that's the most inspiring part about each of our channels and our journeys, right? It's like we're no one special. We just started. And you see that even so, like, reflected sometimes in comments when people are like, wow, like, I saw your journey and I wanted to get started, whether that's as a creator or on an investment journey, which is even, I think, more epic. But now we're in the beginning of a new year, and so I'm super intrigued to know your motivation and fuel coming into the new year, Paul.
Well, I mean, as you guys know, I'm not really working full time anymore other than, YouTube. And my portfolio, it did pretty well last year, but I'd have to say November and December were kind of bummer months. Like things just tanked. And that was my balance, my dividends, everything just kind of went down for 2 months. So I had to rethink my strategy and try to figure out where did I go wrong? What could I do better? So having January 1st, 2026, it's kind of like it's a reset, right? It's a fresh start. It's a new beginning. Now I can write down my total for 2025. Okay. And let's see what we can do in the next 12 months to make it even better.
Ryan and I's last video was actually all about goals. And so now that you just said that, I want to put, Ryan, should I put Paul in the hot seat real quick? I want to.
So the alternate name for this podcast, by the way, is the Ring of Fire, and Paul, you're in it, my friend.
The Ring of Fire. So are we gonna have some chicken wings with hot sauce?
We're just gonna sit around and listen to Johnny Cash. Actually, that's all we do.
Nice.
Just Johnny
Okay,
Cash
I'm down with
in the
that.
background, man.
I'll have to get a Johnny Cash T-shirt.
Well, I was gonna compliment you actually, Sammy Hagar. Much respect. I like the T-shirt.
He's amazing.
Yeah,
I've seen him probably close to 10 times now.
Really?
Yeah.
Okay. Nice.
I'm old, Ryan. I'm old.
No, you're not. You're not.
I was seeing Sammy Hagar, I think, probably before you were born.
I wouldn't have guessed a day over perfection. So, but Ari, let's hear it, man. What are you gonna ask?
The hot seat.
Yeah. So I just based off our last video, Ryan and I talked all about our goals and what we wanted to see happen in 2026. But 2 hot seat questions for you, Paul. The first one is, how exactly did you end 2025? Like, what were some of the numbers? I think my mind was just blown, but I think Ryan's brain will be blown as well with the numbers that you're about to share. It's pretty crazy as an income investor, but then I'm super intrigued to know your actual goals for the new year.
Yeah. So I wrote down a few numbers just so I would be accurate. Right. So this time last year, my portfolio was just over 370,000, which really for somebody my age is not a lot. April 8th, the big dip there.
Yeah.
I went down to 292. So from 370, I dropped to 292. I think it was a $92,000 drop or something like that.
Real quick, when that was going on, sorry to cut you off. What did that feel like? What were some of those thoughts? Were you calm, cool, and collected? Was there a little bit of hesitation? How were you feeling during that?
You know what? Luckily, I started doing my own investing back in 2020. So by the time that happened, I'd already seen some big swings up and down, and you start to realize it's all part of the market,
True.
And if you watch videos with guys like Warren Buffett, they talk about, you don't necessarily have to be the smartest guy in the room, but you have to be able to stomach the volatility.
Sure.
Right? So
okay,
you have to
that's,
be able to
that's good.
And it's a good time to buy, right? I know yourself, you're picking up stocks when they're low, because that gives you a higher dividend yield, and it's a good time to accumulate, right? So it definitely was a good time to buy, although I don't usually sit on a lot of cash, so I have to use my distributions to make those buys. But yeah, I mean,
well, that's okay.
I was pretty good. There are people who panic, and I feel bad for people who panic and sell and, end up hurting their portfolios worse by doing that. But
yeah, and I think I'm sorry to stick on this, but
keep going.
I think honestly that's probably part of this whole process, right? Like probably your first time experiencing that volatility, maybe you felt a different way about it than you did back in April. But I think that's just something, if you're going to be investing for a long period of time, number one, that's something that you'll inevitably go through. But number two, like it's a really important part of the journey because, a big part, possibly the biggest part of being a successful investor is having, having your mettle tested and being able to persevere through that and not jump ship when things get tough. So I think it's an important thing to go through.
Definitely. And this is where a lot of people look to us as content creators to see how do we react in these situations, right?
That's a
And I
good
try
point.
to put out videos where I talk about it very calmly and show people that I'm not panicking and that this will pass and eventually the market will go back up again. And then you get comments like people, oh, thank you for that video. It really helped out a lot. I like the fact that you're calm during the storms, and so it's good. Yeah, it works out well when people see that we're not panicking and selling everything at the bottom and regretting it a few weeks later when the market bounces back.
That's a great point. And I'm sorry again to cut you off, but
No, no
so
worries.
picking it up from April.
Yeah, so then from April to October, the market just took off and my portfolio hit an all-time high of 447,000. And
Nice.
I was starting to see.
What a comeback!
I know, right? I was starting to see 500,000 in my sights. Like, can I get there? And I was so excited. And then my portfolio tanked, and I ended the year down at 386,000. So I'm
Okay,
still above where I started.
Yeah.
I'm above where I started, but I also withdrew $20,000 from my portfolio this year. So I took out 20,000 to actually spend.
Was this your first year pulling those distributions? Like prior to this, did you reinvest everything, or what did that look like for you?
Okay, so for the most part, I always reinvested everything except for when my kids went to university. I got a lump sum of their in Canada we call it an RESP, right? Yeah, RESP is the Registered Education Savings Plan. Because I'm separated, my wife got some money, I got some money, and then the kids every year get money. I took the money that I got for them and I invested it so that I could make it grow and give them more back. So I was pulling a little bit of money out just to help pay for their
Okay.
university. But this is the
Okay.
first year where I was actually pulling money out for myself.
Yeah. Okay, that's
Yeah.
cool. That's
Yeah.
that's pretty cool to get to that point.
Yeah, so if you add it together, I'm actually up just under 36,000.
Okay,
If you add,
so that's
if
like
you add the unrealized
you know,
gain plus
it's like
what
a
I actually
10%
pulled
return.
out. Yeah,
Yeah.
you know what? I was just under 10%, and I was watching your video. I think you were around the same this year.
Yeah, right around the
Right.
same.
So I mean, could it have been better? Yes. Unfortunately, some of the things I invested in, I know Ari and I talked about it last week, were things like MSTR. Right. If I had to put all that money into gold instead of MSTR, my portfolio would be completely different. But sometimes you pick. I'm not going to say it's the wrong stock, but it's just going through a dip right now, right? Or it's down right now. I still believe in Bitcoin and MSTR. So I think 2026 or 2027, eventually we'll see it come back.
What's crazy to me about your portfolio, Paul, is it's not a growth portfolio, but like sometimes it performs like one. I think sometimes investors can kind of, have their sights set on income being the route of safety. It will never dip as much as, as yours had. And you're showcasing the exact opposite. Like that's not the truth 100% of the time. There can be some volatility with income investors.
Definitely. And the other thing, Ryan, if you don't know much about my portfolio, but I've tried, and I'm not going to mention names or tickers or anything, but I've tried a lot of the ultra high yielding products out there. And as we've seen in the last couple of years, they're failing, right? They really are failing. So some of those have brought my portfolio down as well. So one by one, I'm kind of eliminating them. I'm trying to bring my number of holdings down a lot and just get rid of all the garbage.
Yeah, I think that's a good way to go. So with that said, what are you kind of, because that's honestly what I know about your portfolio is mostly that it's I know you mostly as like a covered call ETF investor, and I know that there's other things that you do. Like I think you've got some other like QEXT, I think is not a covered call ETF, right? And that's a position you've been buying lately. I think you probably have some S&P in there, and maybe I don't know if that's even the S&P or if that's something different. I'm not super familiar with the Canadian ETFs, but I know that there's some other things going on there. But I guess what I'm trying to ask is, in getting out of, some of those funds that haven't done so well for you, what are you transitioning into? Is it more QE, XEQT? Is it more, like just conservative covered call ETFs? What does that look like for you?
Yeah, exactly, Ryan. So it's more conservative ETFs where the underlying holdings would be like the S&P 500, the
Okay.
Nasdaq, right? Or in some case, in Canada, we have a lot of sector specific ETFs where you can buy an ETF that say just holds financials or holds energy, holds utilities, but
Mm,
those all tend to be a little bit more stable than something that holds only Tesla, right? Or holds
sure.
only Bitcoin or MSTR. Um, and then, of course, there's the strategy, right? There's some companies who are writing calls on 100% of the portfolio, and they're doing it at the money. And they're trying to get as much premium as they can, but at the same time, they're killing the NAV, right? They're killing the net asset value of the fund, and then the share price drops. When the share price drops, so does your monthly dividends, your monthly income. So it's better to go with funds where they aim to write on only 30% of the portfolio. That leaves 70% of the portfolio to grow.
okay.
Yeah.
So it's like so they own all the underlying. So for example, one like a JEPI or an SPYI, for example, might own just the S&P 500, then they just write straight up covered calls on them. That's kind of more the direction you're going with these.
Yeah. Yeah. And
Yeah.
in the States, there are great ones from like, well, I guess we're not going to name companies, I don't think, but yeah, uh,
My
there are
bad.
really good, solid funds out there. There are some big players. Well, XEQT, you're right. That in Canada, it's actually from BlackRock, which is American, isn't it?
Yeah.
Yes.
Yeah, but I guess it's their Canadian version of funds. So, and XEQT holds over 8,000 stocks, but it's
Okay.
not an income fund. So I added a little bit of growth to my portfolio.
So that one might be more just like a some sort of total market fund.
Exactly. Yeah, I think it's somewhere in around like 40, maybe 40 to 50% holds US listed, and then it's got Canadian listed, and then you got global and emerging markets.
Yeah, man. So honestly, what it sounds like is the direction you're going is really more balanced, right? More balance on the growth side with the income side, and when you put those two together, you get the best of both worlds.
Yeah, well, I spent the last few years trying to get my monthly income up as high as I could, as quickly as I could. But now I want it to be stable, right? I don't want to see those wild swings where one month maybe you make 8 or 9 thousand in dividends, but then the next month it's only going to be three. I'd
Mm.
rather have consistency. So
Yeah,
and build it slowly over time. You know what I mean? So
yeah, absolutely. Especially over a long period of time, because you're a young guy in your late 30s, so you've got plenty of time.
yeah,
You've got plenty of great compounding years left ahead of you. So the growth side of things is important, and over time, you know, it's super tempting. I've certainly been gone through my version of this, but it's certainly tempting to try and maximize your income right now as fast as possible. But you got to think 5, 10, 20 years down the road. And, sometimes, well, typically these decisions that you make with the short-term mindset come at the expense of the long term. And so you really have to find a better balance, and think about both time frames.
yeah, yeah, definitely. Unless you've figured out how to day trade or swing trade, there's no point
Yeah,
focusing on the short term, right? Might as well
true.
focus long term and and build. I guess what I consider it, Ryan, is my base. I want to have a good
Yeah.
foundation, a good base portfolio where I know every month I'm going to get a certain amount of income,
Hmm.
and without any like net asset value erosion or NAV erosion in my portfolio. And then then you can always go for a little bit more higher yield funds to complement it.
Yeah, to
Yeah.
supplement. Hmm.
Ryan and I were talking for man so long, Ryan, about like when will some of these income funds like come to the public eye that they're not all that they're made out to be. And Ryan and I never really got invested into them for different reasons. I think my outlook on my investor profile kind of entirely changed, and I don't feel I need the income. Ryan stuck to his yields, on the lower end, and focused more on like the dividend growers as well. And I just think like by storm, these crazy yields got a lot of investors interested. And Paul, we were talking the other week, and you had shared that you now look for the funds that are around like 12 to 15% yields. And I think that's pretty important. Like that, if anything we spoke about last week, I feel like that was super important. but what was your big push to, I don't want to say open your eyes, but like kind of see that like, hey, like NAV erosion's real and I got to do something about the yield. Got to focus on the yield coming down. Like what made you focus there? And do you think other investors in your shoes see it like that, or are they still on the high yield train?
A bit of both, but I think there's a lot of people now who are starting to recognize that some of these fund companies are just failing. And, some of them have put out 50, 60 new products in like the last year, 2 years. And a lot of investors like myself have been kind of saying, why don't they focus on the ones they have, try to manage them better instead of just continuously putting out, new funds. Because there's 500 stocks just in the S&P 500. They can make 500 single stock ETFs if they want to, right? But meanwhile, half the ones they own are failing. They have a few good ones. There are a couple. If you hit the right ones at the right time, you can do well, right? Until that sector of the market, experiences a downturn, then all of a sudden they fail, right? So for me, I would like to see my portfolio balance growing, even if it's just growing slowly, right? But I don't want to see it dropping. I want to see it growing. And of course, I want to see the monthly income growing as well. And I think long term, the best way to do it is with those, maybe 12 to 15%ers, like you said. I do have a few that pay over 20% because they're tech heavy, right? The tech heavy ones, they easily get over 20%. But I'd rather have a fund that has a basket of tech stocks, say 20, versus just a single ETF. Because if that one particular stock tanks, so does your fund. Whereas if you have 19 or 20, it balances itself out.
Yeah. So with those, like you need some volatility because that's where the premiums come from. But too much of a good thing can be bad.
Yeah, I definitely need volatility. That's for sure. Yeah.
Ryan, has your mind changed on any of this?
No, not really. I think I have, when it comes to covered call ETFs specifically, and we've talked about this before, Ari, Paul, I'm sure you've heard me talk about this before. They're really just not my cup of tea. I truthfully don't have an issue with some of the more conservative ones that it sounds like you're getting into. I think that those can have their time and their place. I think the good thing about those is that you're getting a decent amount of income, 10 to 12%, which for those is like, that's a nice sweet spot right there. I think you're able to be
a steal.
I know that used to be crazy.
That was major steal.
Well, with all these other products that have come out, expectations have definitely changed. And people are used to 30, 40, 50% yields, and now 12%'s like weak, which is crazy to me. But I think that those covered call ETFs, the more conservative, straightforward ones, can be fine. I think they can serve their place in a portfolio. For me, I have a much easier time wrapping my head around like companies that generate sales and profits and free cash flow and pay the income from those operations versus something more derivative based like covered calls or cash secured puts. Not that there's anything necessarily wrong with them, but for me, it's more straightforward. I can wrap my arms around that a bit more. And I don't even mind some of the higher yielding stuff. Like I've got a few high yielders in my portfolio, like Blue Owl Capital Corporation's yielding about 11 or 12% right now. But same thing. I can more so understand where that cash flow is coming from. And so that's really why I stick to those and ultimately have decided for now to avoid covered call ETFs. But like I said, nothing really against them from a fundamental or a philosophical point of view. It's just for me, I prefer this other stuff that's more in my wheelhouse, I guess, if that makes sense.
Yeah. The one thing that might be, I think, a misunderstanding or a misconception that people have about some of the covered call ETFs is if you take a fund in Canada specifically where it holds a basket of stocks, dividend stocks, right? In Canada, we get, for some reason, I think we get slightly better yields than you guys do. Like a lot of our banks and oil companies and that, they're paying 4.5%, 5%, 6% dividends, right? So if the fund holds those stocks, you're getting paid that dividend as well, right? So it's not like you're not getting the dividends.
It's a
right?
good point.
The fund gets paid the dividends. Then they take 30% of the fund and they write calls on that, right? And then they get the premiums from that. And in some cases, they'll add, say, 25% leverage. Not like 2 times leverage or 3 times leverage, just 25%, right? And that's how they kick it up to, become like a 12 or a 13 or a 14% yield.
That's a good point, and I truthfully didn't think about that. I will say though, as far as Canadian stocks generally having higher yields, like the banks and the oil companies, like you mentioned, I'm speculating on this and I'm thinking out loud, but I think one of the reasons for that could also be expectations and what investors are looking for. Like here in the United States, I mean, especially with the tech stocks, and Paul, I don't need to tell you this, but like dividend investors and dividend investing is not like a cool thing to do. It is very, very much growth oriented, and I understand why that is, but because of that, management teams and because of the expectations of investors, they might be given a harder time if they're shelling out cash to shareholders in the form of dividends when they could be reinvesting back in their business or when they could be doing buybacks instead. I think that there's been a huge, I think there's much more preference towards share buybacks if a company is going to give capital back to investors. A lot of investors these days would rather see that happen in the form of share buybacks for multiple reasons. Number one, because it pushes the earnings up, which is then going to push the share price up, which is the cool thing. But then it's also, tax efficient, which is very top of mind for a lot of investors. And there's probably other reasons, but I think investors are just looking for different things here, perhaps. And I could totally be mistaken. I can't speak for all U.S. investors or all Canadian investors, obviously, but that is kind of what I see here.
But a lot of the funds you hold, or not funds, but stocks, the companies you hold like Johnson and Johnson, they do increase their distribution or their dividend a couple of times a year, right?
Yeah, totally. And I think that's one of the misconceptions possibly about dividend stocks. I think when it comes to returning capital to shareholders or reinvesting into the business, I think that it's often talked about from the viewpoint of it being one or the other. I think when a lot of investors talk about it, it's mutually exclusive. Like for some reason, you can't reinvest in the business and also pay dividends and also pay down debt and also do share buybacks. Like for some reason, you can only do one or the other, and that exists in a vacuum. But in reality, that's just not the case. And actually, Johnson & Johnson's a great example. They spend a lot of money on research and development and acquiring other companies, and obviously developing their own pipeline through both of those things. So reinvesting back in the business while also, paying a growing dividend over time. And I think that, at least from my perspective, when I'm looking at a company, I want one that's balanced in that way, that's able to do both. Because once again, it all goes back to having a long-term mindset with this and thinking 10, 15, 20 years down the road. The only way a business is going to really be around that long is if they're going to continue growing and being competitive. And so you can't not just take all the cash and give it to shareholders, but also, I like having that cash-based relationship as well. It's important to me that I'm not just like writing a blank check to management, because yes, reinvesting back in the business is important, but if that doesn't always mean that management is going to make good decisions with the capital that they have to deploy. And so I think the dividend can kind of be, there's probably different analogies for it, but I think it kind of helps restrain management a little bit, or it holds them at least a little bit accountable to the shareholder. And dividends are not guaranteed, but I also think, a lot of shareholders are not going to be happy if the dividend were to go away or to be cut. And so it does create a little bit of pressure. And I'm probably talking in circles at this point, but that's kind of how I think about it.
It's an interesting thought process you have, Ryan, because I look at it from the angle of attracting investors, and for me the dividend is just a way to attract investors, and to keep them interested in the company and kind of, I want to say, growing and thriving with the company. But I feel like when we have companies like we have today, these major tech companies, and really like looking into the future, there's a big difference between tech companies and healthcare companies, right? Mm-hmm. Medicine can be around for years and decades, right? Technology has to be advanced. I mean, you're old news if you haven't advanced by last year already. And
Well, dude,
the
look
rapid
look no further than the semiconductor space, like case in point right there. New chips coming out multiple times a year. Sorry.
So that's where I think the tech companies got to sell it differently. You know, they have to say like, hey, we need all of this capital because if we don't have the ability to invest and quickly, we will fall behind. Like we will lose this race.
I totally agree.
Didn't some of the big tech companies start paying dividends though? Like I'm thinking of Apple, Meta, Alphabet, right? I mean, I'm sure they're very small dividends.
Small percentage.
Yeah, but they'll increase them every year, right? And I think that's the catch is they've got to increase. I mean, if Johnson & Johnson stopped increasing their dividend, for how much longer would you hold on to that stock?
Yeah, and
but
then,
also keep in mind like how established.
Oh.
Alphabet is compared to like a newer but I can't even say it because Nvidia I think is now paying a very small sliver.
Are they really?
But you think about like some of these tech companies,
like a penny.
Yeah, it's like nothing, just enough to attract Ryan.
Yeah, it's a dividend stock, man. It's so funny. Sorry to cut you off, but I've made videos in the past referring to Nvidia as a dividend stock, and I don't do it anymore really, but whenever I would do that, I get so much slack in the comments because it's like it doesn't even count. It doesn't even
comments,
count.
Oh
yeah.
It's funny how upset some people get about our content, regardless of which one of us it is, and if they don't agree with what you're doing. And I think when I used to consume YouTube a lot more than I do now, I would try to question content creators, but not like bash them. You know what I mean? Like just maybe, challenge them a little bit on what they're thinking, but not like, I've had people call me things that are terrible.
Well, it becomes like, and we actually at Ari, I feel like, and Ari, don't lose what you were saying, because I know you're in the middle of something. I'm so sorry that we cut you off. So don't lose that. But we've talked about this pretty recently. I think, investing it's a very personal thing, and it's a very intellectual thing, and you make decisions hopefully after thinking about them for a decent period of time. You've given a lot of thought to what you're doing in your portfolio. And so if you see that someone's doing something differently than you, maybe they're on the complete opposite spectrum of what you're doing, it can almost be received, not rightfully so, but it can be received sometimes as like a personal attack on your intellect. And for some reason, it's easy to forget that there is more than one way to do things. As Russ likes to say, there's more than one way to get to financial heaven. And for some reason, I think that gets lost.
As Ryan says, there's more than one way to skin a cat, man. What are you doing?
Absolutely.
You gotta drop your line.
I want to name drop Russ real quick. I always like to do
I
that.
always try and tell my wife there's more than one way to do things, but she always tells me there's only her way.
Yeah.
But I think that's where that comes from, and it's obviously
she's
easier.
Actually the one that's leaving all the comments.
Oh yeah, there
right?
you go. So I think that's
multiple YouTube channels.
Hey man, there's probably some people out there who actually do that. But
the thing is, there's a lot of things I missed out on. Like I think just before we started the podcast, I was saying how this year I probably should have bought gold, right? And I didn't. But you can't really invest in everything. You know what I mean? You can't really be an expert in everything. You can't believe in everything. So you're going to miss out on a few opportunities here and there. But what are you going to do?
Well, and hindsight's always 20/20. It's always easy to say I should have bought gold, or rather someone in the comments saying you should have done X, Y, Z.
Right.
With the benefit of hindsight. And at any given point in time, we're all just doing the best with the information that we have right now. And it's also important to remember too, stocks go up and down in a given year. But the story is constantly unfolding, The story, we talk about this a lot too. Investing is an infinite game. We're going to be doing this for the rest of our lives. And so the companies that are maybe losers today have, and they have the opportunity to be winners tomorrow, and vice versa. So the story is ever changing. It's ever evolving. And I think kind of like what Ari was saying when it came to the tech stocks, to circle back to that, you have to evolve with it. I was actually just listening to, I've been listening to a lot of Bob Dylan lately, and in the times they are a changing, he's got the line, you better start swimming or you'll sink like a stone. Well, that's kind of true with investors. You gotta start swimming, or companies as well. Sorry,
I always think to anybody who, says that Ryan's not got the right philosophy, or you don't, Ari, or I don't. Honestly, if we could all go back 15 years and just buy Bitcoin when it was like a buck a coin,
yeah,
has
seriously.
anything outperformed that? But when somebody told me about Bitcoin, 10 years ago or 15 years ago, I thought it was the dumbest thing I'd ever heard of. And I was like, there's no way I'm going to put any of my money into this at $1 a coin. So.
Well, it's funny, like Nvidia's also kind of an interesting case study, and I could have my details slightly wrong on this, but I remember reading recently in an article, back in the day, Nvidia was more so known like in the gaming space. That's kind of where they were. That was kind of their niche, and obviously they've since evolved beyond that. But even if you were to go back in time, before Nvidia became what it is now, a lot of the people who are deep in that space, like heavy gamers that use their products and building out their PCs or whatever, they wouldn't have anticipated that Nvidia would become what it is today. And so, there's a lot of luck involved. There's a lot of random things that happen that you'd never expect. Amazon's another great example. So there's all of these different examples of just the future being so unknowable and so much different than you could ever expect. And in a lot of ways, we're just kind of along for the ride.
It comes back to circle of competence, right? Like only as far as and usually, like, if you're a gamer, for example, great point that you brought up, you probably knew a whole lot about Nvidia, maybe you didn't, right? But you had a better chance. Or if you were someone who was on the forefront of cryptocurrencies, your head was somewhere in that space already. And therefore I hate playing Monday morning quarterback. It's so annoying when people do it in the comment section or other creators, right, or investors. They'll call you out for something, and it's like, yeah, but I didn't know what both the two of us, all three of us, no one knew what it was going to look like today 5 years ago. And so that's where you have to go back and really just ask yourself, in the present time, well, what do you really think? What's the conviction on this? Where do you really see this going? And while so many people did make a fortune on, for example, Paul, you mentioned crypto, a lot of people didn't, because they had no idea what they were doing. They just kind of jumped in and maybe it will go somewhere. So I almost feel like, too, there is a bit of, luck that will come into play for some investors that are just throwing money somewhere and hoping it sticks. And I feel like that was a lot of the crypto investors. A lot of crypto. I have a friend of mine, and she always talks about her brother. She's like, my brother is so smart about crypto and blockchain. I'm like, well, when did he invest in it? And she was like, years back, right, when it was almost nothing. Now this kid, he's like a kid, but he's loaded. And I started asking some questions. He doesn't really know anything, right? But he just threw money in and placed a big bet, and it took off. And that's cool. I respect that, right? It does take, I feel like, some kahunas, if you will, to just throw money in like that. But to be an investor is something different. Like, that's what we're all in the business of doing. We all do research. We generate a thesis. We have conviction. And it's so different. And so when it's time for the Monday morning quarterbacks to meet us, I feel like even if I'm wrong about something, at least I had a thesis and a process.
Yeah. And I don't know about you guys, but like you said, hindsight's 2020, right? Once something happens, you can look back and say, wow, look, if I had just bought Nvidia at whatever it was at, $100 or $200, and rode it to $900, I'd be rich. But then I look back and say, like, for example, look at Kathy Woods. Correct me if I'm wrong, but didn't she sell out at the bottom? Like, didn't she get out of Nvidia, right? and moved her money into something else? And she should have access to way more information than we do, right? The other thing is, if I had bought Nvidia at $100, I probably would have sold it at $200 or maybe $300, right? Because at that point, you're like, look at how much I'm up. This is eventually going to tank, right? So you're going to sell out probably way before the top.
Yeah, that's the tricky thing about buying, and that's a tricky thing about investing for the share price. And not that a growing share price isn't important, but you are trying to time it in two ways. You're trying to time when you get in, you're trying to time when you get out. And I will say, this is one of the merits, I think, of investing for income or investing in dividend paying stocks, is that it does add this other dimension to it where you're not as beholden to timing things either way. Not, once again, not that it's not important, because I think a growing share price, you need that over a long period of time. But I will say that is one of the things that does keep me investing in dividend paying stocks is that extra dimension beyond just the share price.
It's a little bit easier, right? You can sleep a little better at night because you're not worried about timing the market as much as some people might be. The other thing I find is that if you didn't get in early, but now all of a sudden all your friends are talking about how they made money in Tesla or they made money in Nvidia, so there's FOMO. So now all of a sudden you want to buy it, right? You didn't buy it at $100 or $500, but now it's at $900. You want to start buying it. And usually they split the stock, so they bring the price down. You start buying it, and then it goes through a correction. So now you're panicking because you're losing money, and you sell out. And then 3 or 4 months later, it recovers again. And then you start to buy it again, right? So there's a lot of people who do that. They only buy things when they're doing well, right? They buy at the top. They can't ride out the correction. They sell and lose money.
These are the convictionless investors. Like,
right?
You know, they just go in because it's like you said, they have FOMO. They're looking at what their friends are doing, or even worse, by the way, they're looking at what creators are doing. There's no way. I guess now they're at, you got Blossom and whatnot, but like for the most part, you get all three of us. We're talking about what we're investing in. There's no way that we're going to answer, hundreds and hundreds of personal messages or emails about our exact investment moves, when we're doing them, and, what triggers we're pulling. And I think that's something also to think about. It's safer to go along with a friend to some extent, because at least you can have open conversation and dialogue with their whats and whys, versus creators who might create a video this week, and by a month from now, we might sell out of something or buy something else, and people don't know until days later, if ever.
That's a good point, man. And hopefully, hopefully we're not putting ourselves in too many situations where we're buying something and then a month later selling out. But yeah, that is certainly one of the occupational hazards. And, as we've talked about before, I don't think you could ever completely avoid that. It kind of just unfortunately comes with the territory. In the same way that people look at Buffett's 13F or Berkshire Hathaway's 13F and make moves just based on that too. So by the way, guys, that is not a comparison between us and Berkshire Hathaway. I just want to disclaim that.
Comparison, man.
Yeah. I also, I was just going to say, I love when people make comments about, how come Warren Buffett doesn't buy, whatever I'm investing in or somebody else is investing in. And then you look at their portfolio and it's like, well, how come you're not invested in Berkshire Hathaway? You know what I mean? If Warren Buffett is who you believe in, then why don't you just buy his stock and not worry about anything else? But it's one of my pet peeves.
I think, to that point, it's so easy. It's so easy to create the argumentation around, someone else's investment move. And it goes back, I think, to what Ryan was actually saying a little bit earlier. It's like when the ego gets hurt, it feels a need to defend itself or go on the offensive. And so if you two aren't doing what I'm doing, then somehow my ego might get hurt because maybe I'm actually doing the wrong thing, and now I got to get defensive about it. And it's like we could all be right. All three of us actually have very different investment styles as of this video, but I'd like to say we all crushed it, and we all surpassed our goals in 2025. So there's 3 W's across the board.
Absolutely. And that's a great point too. Everyone has different profiles and different goals in their portfolios and different things they want out of their investments. And I actually think the 3 of us right here are a really good example of that, because we all have our similarities, but we also all have the differences in how we approach our investments and what we want out of them as well.
Yeah, 100%.
Yeah.
Oh, go ahead.
You go ahead, Ryan. Go ahead.
I was going to change the subject. I've got a question for Paul, but if you were going to say something, I won't forget it. Or I'll try not to. So go ahead, man. I'm sorry.
We got Paul on with us. We're kicking off the new year.
Okay, well, I was just going to ask Paul in changing the subject. You are at a place where pretty much all of us are trying to get to. We are all trying to reach retirement, all trying to reach financial freedom. I want to know, number one, like, how does it feel? How does it feel to be retired and to be living off your investments and to be, free, essentially? Number one. But number two, are there any ways that it's different, either better or worse than you expected before, you got to this stage, if that makes sense?
I would say the better part is not having to go back to the job that I used to have and the commute that I used to have to work. I don't miss the stress of the commute I used to have, Ryan. I used to drive an hour and a half to work and then an hour home. So 2.5 hours a day just fighting traffic was miserable. So I don't miss that. And, I worked for a company that didn't really appreciate their employees. So I don't miss that as well. Have I retired on my portfolio 100%? No. You know what I mean? Because I got let go, I'm collecting employment insurance right now, trying to help, because I don't want to kill my portfolio at such a young age. And you know what I mean? I'm hoping to live to 100. So, you know what I mean? I don't want it to dissolve before I get there. So I'm still trying to build my portfolio. I'd like it to get a lot higher than it is right now. So I'm not 100% living off my portfolio. I do have some other, revenue coming in, but it was really nice. I'll be honest, when I found out, and I kind of knew it was coming, that I was losing my job, just knowing that I had enough passive income that I wasn't going to be, stressed or, not able to afford my bills or anything like that. So that's a nice thing to have. I'm not worried about, like say I had a decent growth portfolio, but all of a sudden the market dropped 30% and now I got to sell shares at a loss and stuff like that. So it gave me a nice buffer. Like it gave me a nice safety zone where I was actually okay with being let go, as opposed to panicking and trying to find another job the next day and stuff like that. So yeah, it was good.
And so now, I mean, in addition to those things, your portfolio, the employment insurance or unemployment insurance, and now YouTube. I mean, YouTube's a whole extra, revenue source for you. I mean, just between those, I guess what I'm asking is what's the long-term plan? Can you sustain this, do you think, and it's hard to say forever, but can you see yourself sustaining what you're doing now? A mix of YouTube and the portfolio paying the bills. Are you in a place where you feel like that's sustainable?
That's actually the video that I put out yesterday. It was kind of like yesterday, or maybe the first, I can't remember, but it was sort of my 8-step plan on how I'm going to move forward now that it's 2026. It's the first year in a long time that I don't have a real regular full-time job. So what was my plan? And the first step was just to be debt free, which I'm basically debt free. I do have a mortgage, but my mortgage payment is nothing. Like, to rent the house that I'm living in would cost me about 3 to 4 times more than my mortgage payment, right? So if I sold this house, I could pull about $1 million of equity out of it. And I've tried to convince my wife of that, and she hasn't gone for it yet. I'm like, babe, look at if we can invest $1 million. Imagine the monthly income we could make. But she likes the security of having the house, owning the house, right? So, so there was that step. There was my passive income is another thing that I'm using. There's the employment insurance. My wife works as well, so we have her income, but we keep our bills separate. It's our second marriage, and I think people, when they get married a second time, they kind of keep things a little bit more separate. So we just split the bill. She takes care of hers, and I take care of mine. But I kind of gave myself 6 months. Like, let's see how this goes for 6 months. And if my portfolio's tanking because I'm pulling money out of it and it's, things are not working out as well as I thought they would, at that point, I might have to look at getting a full-time job. I also talked about having a semi-retirement job, which I don't know if you guys have ever thought about it, but, find something to do, that's not stressful. You know what I mean? Like, just, when you take your car in to get fixed or something and that guy shuttles you home, or, you walk in a Walmart and somebody greets you, just like an easy job. And I live in a very small town. So I want a job in town where my commute is like 8 minutes. Like I'm starting work at noon. It's 11:50. All right, I better go. As opposed to before where I was leaving 2 hours before, just in case of traffic.
Yeah, that's so funny that you bring that up. So we just talked about this a couple weeks ago. We have our little deep end book club that we started, and in December
Nice.
we read a book called Retire Often, which is all about taking these mini sabbaticals or mini retirements from work. And one of the themes in the book that the author talks about is this idea of having two separate careers. On one hand, you've got your first chapter career, which is like the one that you commuted 2 hours every day to. It's the one that sets you up for your future. It's the one that you use to really like just set yourself up for the future. It's maybe not the most fun job. Maybe it's got the arduous commute. You're not really doing it because you like it. You're really doing it for the money and just because you need that. But that first chapter career then paves the way for you to at some point hopefully enter your second chapter career, which is exactly what you described. It's the fun job. It's the more relaxed job. It's the one that you actually want to do. Yes, like maybe you need it a little bit to pay the bills, but it's really just to supplement, your investments or the other projects that you have that are bringing in income. It's just kind of a fun job. And I think it's, worst case scenario, if you had to go back and enter that second chapter career, it's like, man, that's actually probably would be fun. It probably would be a nice addition to your routine versus just being fully retired. And I don't want to say, I know you're an active guy, so I don't want to say just sitting around, but like not having something to do, I suppose, which so many retirees do. There are a lot of retirees who don't really know what they're going to do and how they're going to fill all of that time. So I think the second chapter career kind of comes into play there. And it's funny because when we talked about this a couple weeks ago, I told Ari and I told everyone, worst case scenario, if things in the portfolio ever went south or things on the YouTube channel ever went south, I would do that. I would just go get a job at Trader Joe's and be a greeter, and everyone there is super friendly. It's a good gig. You get nice benefits, decent pay. It's like, I think there's a lot of worse things that you could do, and it'd be kind of a fun gig.
Yeah, there's a lot of I think there's a lot of benefits to it. On top of the income, right? The little bit of extra money,
Yeah.
but just to sit at home all day, every day, and do nothing. Like you hear about a lot of people who work their whole life, retire, and 6 months later, a year later, they pass away, right? Because you're not exposing yourself to social interactions anymore. You're not meeting with people. You don't feel like you're important anymore. You don't have anything to do. So
Yeah.
yeah, I think there's a lot of mental health benefits and physical benefits to actually just getting up and going to work. And if you can find a job where you can work 2 days a week, 3 days a week, 4
Totally.
days a week. I've talked to a bunch of guys in town recently. Like there's some guys that are, in their late 60s who they went back to work because they don't want to sit at home all day, every day doing nothing. And I mean, I'd love to travel more, but my wife she's got 3 jobs. So finding vacation time for her is not easy. Last year we made it to three vacations, but in between those 3 vacations, what are you going to do, right? You can't just sit at home and do nothing. And I mean, we all do have YouTube, which keeps us busy, but that's just you sitting at home by yourself, right? So it is nice to get out and do things.
Yeah, absolutely.
There was someone that I met actually on the Blossom tour, and I had him on Masters of the Market as well. But dollars with Drew, and he was actually an engineer for a bit of time, and he lived very frugally throughout his 20s, and eventually meets his the girlfriend turned fiance turned wife, but then he ends up quitting his engineering job and started picking up these side gigs and hourly jobs, like at McDonald's. He worked at Amazon warehouses. I think right now he's doing some work for UPS. But he loves it because he's like his big thing. First of all, he grew his portfolio in his 20s. He got to, I think it was $300,000 by 30, and now
Wow.
he's 36, I believe, but he's got 750,000 in there, and he just works these hourly jobs. And he's like, I love it because, when I go, first of all, it was interesting because he was like, I still have the engineering mindset. So he was like, when I was working at, these fast food restaurants, in my mind, I was trying to understand how we can do this process more efficiently. Another interesting point was he would go to speak to the managers about efficiency based on, his background, but they just saw him for the uniform that he was in. They were like, okay, you don't know anything really, which I thought was really interesting. But nonetheless, he's like, look, I get to leave work at work. I clock out of an hourly job. I don't bring it home with me at all. And I think that's sometimes the greatest piece.
Exactly. You want to have a job where they pay you to come to work and do what you're supposed to do, but they don't really pay you enough to worry about it, right? They don't pay you enough to be stressed over it. And like you said, when you get home, you just forget about it. Yeah. I think that's the way to go. That's my plan.
Well, I think that's a good plan, man. I think there's plenty of worse things you could be doing. And, I'll say it, Paul, you're an inspiration, man. Keep up the good work.
Thank you. I know there's a lot of people around my age or a little bit older who are. Go ahead, Ari.
I was just gonna say, it's, what Paul has built, I think is important because of the fact that it kind of comes back to what I had often spoken about in previous episodes, but like having that FU money, if I can say that, just having the ability to just walk away in peace, and not be threatened by, I want to say society advancing in AI and all these things that are happening, because we have been seeing more and more. I mean, workforces are shrinking, and usually the ones to now fill some of these seats are the younger individuals with the coding backgrounds, the AI backgrounds. But if you're smart and pulling these triggers, Paul, you already pulled them. There's no reason to be concerned. There's zero reason to be concerned. You're from what I recall, your portfolio is bringing in around 11K in dividend income, or in income. That's crazy. That's more than some people are bringing in with their salaries.
Yeah, and I don't get me wrong. I'm not going to try to tell anybody that I made $10,000 a month in dividends. That's not $10,000 that I would pull out, right? You have to reinvest. You have to keep, you want to keep your portfolio stable. I don't want to see it tanking because I'm pulling out more than I should and not reinvesting a bit, because a lot of times these funds are paying you a lot as opposed to reinvesting. Like you were talking about, Ryan, with companies, they could be reinvesting the money or they could be paying you a dividend. So when you're getting these high dividends, you really need to think about, okay, how much do I actually need and how much should I put back into the portfolio to keep up with inflation, to keep growing the portfolio, keep growing that income. But it's been great. I can't complain about it, to be honest with you. And the other thing is I budget things. So like for right now, what we do is we say, okay, we make money from YouTube, put that towards a vacation. So now our vacation money is kind of taken care of, right? If I get a part-time job, if I want to go out with friends and, have chicken wings and beer or waste money, I can afford to do that because I made a little extra money, right? As opposed to being a person who says, well, I just want to sit at home and do nothing. I'm for the financial independent, retire early, but I can't afford to go out with my friends. I can't afford to go to the movies. I can't afford to go on a vacation. I can't afford to do anything except for pay my bills. So that I don't want to do. So I kind of budget, my expenses, and the portfolio will cover most of my fixed expenses, which is amazing. It's the extras that I need more money for.
A lot of investors have this notion that when they invest in the funds that you invest into, Paul, you can actually just quit your job and live off that income immediately. But from what I've understood from your story, that's really not the case. So is there like a sustainability equation that you use to discern how much income you can pull out on a monthly basis?
Well, I think the problem is that there was some funds, that held stocks like Coinbase and MSTR and Tesla, that when they first came out, they were distributing crazy amounts of money. And, if you put in $100,000 or $200,000, your monthly income was so high that you probably could have lived off of it, until those underlying holdings tanked, right? And the funds crashed, and now they no longer pay those, those distributions anymore. So at one point in time, you might have been making $10,000, $15,000 a month. Now you're making 1,000. So you really have to, like we were talking at the beginning of the show, you got to focus on those funds that hold the SPY and hold the NASDAQ and hold strong sectors and stuff like that, where the monthly income is actually more predictable and doesn't fluctuate as much. You're not going to make those, 80, 90% yields, but at the same time, that every month you're going to pull in what you need to pull in, give or take a little. But I haven't come up with an exact formula to answer your question, Ari, as to how much you should. But I think the bottom line is you should reinvest as much as you possibly can. Use what you have to, but reinvest as much as you can.
Yeah, I mean, Ryan, maybe you've seen the same. And maybe it was when all the hype was around these funds, but I feel like just so many people had the notion that they were going to invest and retire now, and that was when I was reading a lot of those comments. That it was on Blossom a lot of the times. It was pretty scary to read that because you had young, like 20-somethings investors that were like, "I'm investing all my capital into this." And like I'll be retired by next year, and I'm like, what?
And people did it on margin.
Yes,
People did it on margin. Yeah.
Well, listen, if this is just something that's rooted in human nature. If you want something bad enough, you will tell yourself whatever story you have to believe it, to make it real. And
Right.
I think that you saw a lot of that happen when it came to a lot of these funds, which, to be honest, I mean, you see something that's yielding 80, 90, 100%. Some things you got to learn the hard way, but
Yeah.
I also think on the other side of that, it's like there's just some things that are too good to be true. And I'm just as me personally, I think it's easy to look at something like that and think there's got to be more to the story here. Really, like a 100% yield, locked in, sustainable. But that's me thinking like, okay, if I'm going to be retired, I'm going to be retired for the rest of my life. But maybe that's the disconnect, right? Maybe it's like, this is what I can get now. I want to retire right now. I'm done. I want to be out. So I'll just do it. Looking for, I guess, the magic fund, I suppose.
Yeah, there's I think the guy who kind of set up all these funds, who created it initially, and I think he did do a good thing for the market by starting it, but at the same time, the problem is you have to be a more sophisticated investor than I am and than most people are in order to buy these funds, because you have to figure out how to hedge your downside. And I think he actually wrote a book about hedging. Okay. And I don't know how to do it. I don't do it, but it's almost like you're buying these funds that are producing while the market's going up, but you have to buy puts or something else to protect yourself on the downside. And if you don't do that, then when the downside comes, you lose everything you gained, right? So I think you really do have to be more sophisticated than most investors are in order to buy these type of funds, or you have to know when to get in and when to get out of them. I don't think they're long-term holds. People thought they could just buy them and hold them forever, and they learned the hard way that you can't.
Yeah, I will say, to your point, I think that's exactly what happened. And even though it sucks for those people who did lose money, I think it's an important lesson to learn. I think we all kind of have our own versions of something like that. You want to avoid it if you can, but sometimes you just can't. There's just some things you have to learn the hard way. And I still think if that's what it took for some people to start investing, even if this wasn't the best entry to it, if this is what it got them to start investing, and they can move on from that with maybe a more sustainable long-term approach, ultimately at the end of the day, I still think it's a net positive.
Yeah, definitely. I agree. And I think I told Ari before,
For sure.
like I got
think,
my son. Go ahead, Ari.
No, go ahead, Paul. I think
I was just gonna
I know
gonna
the
tell
story
Ryan,
you're
like,
about to share. It's a good one.
yeah, I was just going to tell Ryan, like, I have a 20-year-old son, and when he turned 18, I got him to open up his tax-free savings account, which I think most kids don't do. I got him to start investing, and I put him into some of these income funds so that he could see every month he was making more money, and it kind of got him hooked on it. And now he's 20 years old. We've added a growth portion to his portfolio, right? So now he's buying XEQT and FEQT, so funds that don't really pay much, but they do hold, total market, like you were saying, and over time they will probably outperform his income funds. But he uses the income from the income funds to buy the growth funds because he doesn't have a job. He's in university.
Yeah. Is he into it? Like, is he interested in what's going on in his portfolio, or is it more of like a, I'm just doing it, don't really care kind of thing?
No, he's really into it. Yeah, my daughter
Cool.
is the one who doesn't care. I set
Okay.
up her automatically so it deposits money and makes buys for her, and then she never looks at her portfolio. But my son,
That's
he
great.
opens his, yeah, he's on his Wealthsimple every day. He actually, I think I told Ari, he bought a gold stock with some friends at university, and he bought it when it was about 85 cents, and it's over $6 now. So he's done really well with his one
We'll
gold
chime back
stock.
in.
Yeah.
There it is.
No, that's really cool. And I think like one of the, outside of his portfolio, I think one of the big benefits that's going to come from actually being interested in it when he does, start working and paying some of his own bills or whatever, just kind of, starts up his life and the expenses that come with that. I think his interest in investing will keep him on the straight and narrow in terms of his budget. I think because he knows, because he's interested in this stuff and wants to put money in there and see it grow, that's going to prevent him from making other poor financial decisions. So I think that's one of the really cool things about, number one, investing, but also getting people started investing when they're young, is they're already establishing this good frugal mindset. But it's not because you feel like you have to or it's pulling teeth. It's because you actually want to, so you can continue building this thing that's already, that you've been doing for the last however many years.
Yeah, exactly. And I test him now, right? Like, so for Christmas, he didn't really want anything. He doesn't need really anything. So I asked him if he wanted $300 cash for Christmas, or you want me to put 500 in your TFSA. And
There
he
you
took the
go.
500. Yeah, he took the 500, put it in his investment account. So it was great.
Good move. Good
Yeah.
move.
Smart man. Smart man.
Yeah. Yeah.
I think just to Ryan's point that Ryan, you made earlier, it's like, hey, even if you lost money on these funds and this was your big start, I would imagine that just being in the game is fun in of itself. And so you saw at one point, at least, your account growing. And even if it came down at the end, that should keep, in my opinion, it should keep a lot of investors invested in this game, knowing that there is potential there. In my mind, I just hope everybody is going to be, savvy enough, hungry enough, motivated enough to start to figure out the whys. Why did that go down? Why, why did I ultimately lose money? And asking yourself those greater questions, that's what begins to make someone an investor. Because anything else, if you're not asking those deeper questions, in my mind, you're just a gambler. We were talking before about Bitcoin. If you just threw money in, you made money, cool. That doesn't make you an investor. I can go to Vegas and go to any slot machine or table and hopefully win something. I don't want to use this analogy too far because I'm like, then I can learn how to count cards and then I can, But you can start to do your stock research. You become an investor, and once you're an investor, that's where the game changes. I've found that's where it becomes really fun because, like anything else in life, once you start to learn how to play the game, any game becomes fun. Sports are so boring if you don't know what's going on. But then you learn the rules of the game and everything becomes interesting. It's exactly like investing. So, yeah, my big hope is that even if people lost money, they've enjoyed playing the game for that snippet of the time, enough so they can start becoming investors and asking the right questions.
Yeah, and
Yeah.
you have to learn, like Ryan said, you have to learn from your mistakes, right? It's the cost. I can't remember who I heard it from first, but there is a cost to being an investor. It's kind of like investing university, right? And you lose a little bit of money on a few different investments, and you start to learn from those bad investments, and hopefully that'll carry you forward in the future, not to make the same mistakes. Sometimes people like myself, it takes a few more times to learn, but as long as you're learning over time, and growing that way. Ron, you know what
Yeah.
I'm wondering, you track your portfolio very closely, and I know you have very specific and set goals. What are your long-term goals? Like say 20 years from now, 25 years from now, do you have a point where you need to get your portfolio to $1 million, $2 million before you can retire? Or is it a combination of
Yeah,
a work pension plus your portfolio?
that's such a good question. So it's kind of an ever evolving thing. At this point in time, I tell myself that I will probably start pulling some of my dividends when I reach a point where I'm averaging about $2,000 every month. And I figured that at that point, maybe I can start pulling like $1,000 a month, using that to start paying some of the bills, take the edge off there, but then
Hmm.
reinvest, the other half back into the portfolio and kind of, you know, expand on that as the income continues to grow and slowly but surely over time pull more and more and more of those dividends. Um, but and I think this has changed since I started investing. I think it will continue to change as time goes on. Um, I feel very fortunate, and I'm really going to knock on wood. Like I probably should just keep doing it, but I feel very fortunate that like I can do this YouTube stuff full time, and this is paying the bills, and I hope that as long as I live, I can do this. I'm planning on it in some way, shape, or form, and so with that said, I don't feel as much of a rush to pull the dividends because I do have this good thing over here. And so as long as that continues to be the case, then I won't have much of a need to pull the income. Um, but I might still anyway because I also don't want to find myself in a position where I like start to feel guilty for pulling that income. And I don't know if that makes sense or if that's something that you or other retirees have experienced, but I think it's easy for us to feel guilty pulling money out of our accounts because we want to keep the compounding process going as much as we can. And so I think by kind of starting small, maybe pulling out $1,000 a month when it gets to that point, I think that's going to help train me to be okay with starting to pull some of that income. So I think it could be important from that aspect, but I don't really have any grand plans. Like the only loose one that I have is that $2,000 per month one, but I don't really have any set like portfolio value goals. I'm kind of just taking it year by year, day by day, and hoping that I can just continue progressing along the way. As long as that's happening, I'm happy. And I also say that knowing that once again, this is an infinite game. I'm only 32 years old. I've got so much time to see this thing grow to something crazy. And I know that it will if I just continue taking steps forward. So I'm in no rush. I think that things will work out in the grand scheme of things. And, until then, you just have to be patient and keep chugging along. And so that's all I'm going to do. Hopefully that answers the question.
Yeah. Did you say you're doing YouTube full time?
Yes, sir. I
So,
am.
so you
I've
don't
been
have another job right now?
No, this is it. I've been doing this full time now for about actually just over 3 years. It was 3 years
Really?
back in October that I've been doing this full time. Yeah, yeah.
Wow, that's amazing. Do
Thank
you
you.
have do you
It's been
well, I
a
guess you have two
wild ride,
channels,
and I
right?
I love it. Yeah, there's just my main channel and then this deep end channel here. But yeah, between the two, fortunately, it can keep the roof over my head and pay the bills. And kind of like you, we don't have super crazy expenses. We've got our mortgage, we've got groceries and utilities and stuff like that. But we keep our overhead pretty low, and I'm hoping that that
Do you have
continues to be the
kids?
case as time goes on. Yeah, we do have a baby who's actually 3 months old today, so that's a relatively new thing.
Oh, congratulations.
Thank you. But yeah, that's pretty much it. So it's a combination of those things, like keeping our expenses low really helps. Obviously, this is a duh statement, but it really helps be able to do this full time. So
Yeah,
yeah,
definitely.
that's why I'm knocking on wood. I love doing this so much. I just I don't want to do anything to jeopardize that, and I hope that that continues to be the case forever. Because when I do get into quote unquote retirement, I mean, I kind of feel in a sense retired already. But this is such a good project to have, and I know like as I get into my later years, like much later years, this is something that's going to continue to keep my mind sharp. There's a sense of community around this, which is going to be good for longevity. It keeps my mind active. It keeps my mouth active. That's for sure. And so I think this is going to be a good project to have. So that's why I want to continue working on it for as long as I can.
Yeah, that's great. That's amazing. So are you a stay-at-home dad then?
Yeah, I'm a stay-at-home dad. Yeah, and my wife. So our baby was born October 3rd, and my wife works at Lululemon, and they have a just really good like maternity leave. I mean, really good benefits, really good parenting leave stuff. And so my wife is actually going to be able to be on maternity leave till like the beginning of April. So that's like about 7 months that she'll have been off of work, and that honestly is such a blessing. I can't tell you how fortunate I feel that we can do this, like, and have this much time together during this stage.
Yeah, it's a lot of fun. I was lucky enough to be a stay-at-home dad when my daughter turned 1, and I was still working, but working from home, and got to be there with my kids for, like the first 15 years was great.
Oh, that's awesome. Wow, 15 years. That's really awesome, man.
Yeah, I mean I always say there's pros and cons to everything. What I did was somewhat stressful, but you know, the pros of being at home with your kids, you can't ever take that away from somebody.
Yeah, very true.
Hey, at the
Go ahead,
end
Ari.
of this, yeah, I was gonna say at the end of this whole road, like you're going in your casket, and that's it. So people are gonna show up with memories, and hopefully only good things to say. And I always think about, way into the future. Obviously, hopefully, I guess I'll use Ryan's knocking on wood there, but it's like, well, what do you really want people to come to your funeral and say? Like, oh, Paul worked his whole life and never spent time at home. Ari worked day in and day out, never experienced anything else. Ryan was totally gone from the family because he's been working. Like, to me, when I hear, eulogies, it's people talk about like when those that they loved were around and the lessons they were able to instill. I think that's where the real wealth always comes from. It's like, hey, you only got a certain amount of time in this life, some fewer, some later, but how are you living? Like, what's the quality of your life like? And I've found personally that if you're living just to work, there's nothing behind that, really. And besides that, the people who spend 24/7 in the office, Paul, I'm sure you've spent plenty of time with people like this. Ryan, you've been out of the office game a while, but like they usually don't have anything fun to say. They don't have a lot going on, aside from the work that's right in front of them. And so I think the people who have been able to experience life, the wealth of life, from their freedoms and actually choosing to experience life over work, they have something to say. And that's always worth more than anything.
Yeah, and kind of to add to that, I will say, like, one of the great hi.
You know what she's trying to say, eh? This
the real star of the
is too
show.
long. She's like, okay, that's it. You've had an hour.
We'll
No more free
wrap
time.
It up. We'll wrap it up. I just wanted to say, I feel like one of the great things about being able to do something like this, and why I would recommend starting a channel or TikTok or Instagram or Twitter or a newsletter or a blog, anything like this, like putting yourself out there on the internet. The reason I'm such a big advocate for this is because I feel like it does kind of blur that line between work and life. Like this, yes, this is my work. Yes, I make money from this, but this is also like an extension of myself and my thoughts and my creativity. And also, hopefully, it's a positive thing for the people that consume the things that I'm putting out there. And that, that's rewarding for a whole different reason. And so that's why I say I feel so fortunate to be able to do this. And I feel like it's kind of, the lines are kind of blurred between work and life. I don't want to say like I'm always working. I don't really like that. I'm not a big like hustle guy. And so I don't want to say that, but I'm always thinking about this stuff. I'm always thinking about stocks and YouTube and, my portfolio and my family, but it's like it's not separate. It all kind of blends together. And I don't know, I think that's a really special thing. And I love that it's that way.
Yeah,
100%.
especially when you get a chance to work, or not even work, but do something like we do in a capacity that you're so passionate about, right? even before I was on
Yeah,
YouTube,
absolutely.
I would hang out with friends and we would talk about stocks all the time. You see the wives rolling their eyes, right? All the guys are talking about investments again. But and now to be on YouTube gives me an opportunity to meet guys like you. Like we would have never bumped into each other, you know.
Right. Right.
Chances are, unless we happen to be at the same all-inclusive resort somewhere someday, but you know what I mean?
Which maybe we
being
could
so
maybe we could make that happen at some point. That'd be fun.
that'd be great. But anyways, so it's just been great to be able to talk with guys like you and, to meet the guys who actually own Blossom, the guys that started Blossom, to meet them in person and, meet Mark. Meet Mark was great. So it's a lot of fun to be able to connect with people that you would never get a chance to connect with through, other than
100%.
maybe talking on Blossom, just chatting with people, but not to actually talk to them.
Yeah. Well, 100%. And it's a great community. For the most part, it's a very positive and uplifting community, and everyone is working toward the same goals, and we don't have to, despite what some may think, we don't have to step on each other's toes to get there. And I think that's a really, it's not a zero-sum game is what I'm trying to say. And so I think that's a really unique thing about this community. And I'll say it 1,000 times. I just feel so fortunate to be a part of it.
Yeah, I agree.
Well, to bring us home at an hour and 20, it's been a riveting conversation, but it's also the beginning of a brand new year. So everything that we're talking about now, right, finding your joys and your passions and actually living a life beyond your wildest dreams is achievable, but you have to start. It's the perfect time to start. You got 3 investors in front of you on this screen, from Ryan, myself, to Paul, different investing strategies. You can find us on Blossom. Definitely comment down below with what you thought about the episode, or if you have questions for us. But let's get after it in 2026, because it's really all achievable as long as we start. So I don't know, Paul, if you have a final message for everybody, and then we'll close out.
Get on Blossom, start talking to some people, learn as much as you can, invest in yourself, right? Invest in your own education. Don't do what I used to do and just send your money to somebody else and blindly let them invest it without, really taking a look at whether or not it meets your needs. And if it does, great. But if it doesn't, you have to be in control, because nobody's going to take care of you, better than you can. And, life's it's the whole picture, right? You want to look at your health. You want to look at your family, your friends. Like you said, at your funeral, what are people going to say about you? You know what I mean? Did you live a full life? Did you do things more than just go to a job you hate and complain about it every day, which most people do? So I'm rambling, guys, but I really hope I get a chance to come back and talk to you guys in the future.
We'd be honored to have you back soon, man. Thank you so much for taking the time. It was a real pleasure being able to chat with you, and I can speak for Ari too when I say I look forward to doing it again sometime soon.
Thank you. Likewise.
100% investors. Yeah. Until the next go round of the deep end, we hope to catch you all in the next episode, and we will see you all there.